This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and have a look at the example, shall we, that we promised you in the last video. So you've got an example there. It's all about the group statement of profit or loss and other comprehensive income. Again, you can see that you're given two companies. These are there, Vader and Moore. So essentially, it's all about who's the parent, who's the subsidiary. May there be any associates? Because don't forget, we're looking at basic group structures. So parent, sub-associates. And let's go through there. Wow, there's lots of information. And go through there and have a look at the requirement. So we need your consolidated statement of profit or loss and presumably other comprehensive income for the Vader group. So Vader must be the parent, and the year ended is the 31st of December 2015. So I know who the parent is, I know the year end. Let's look at the additional information. So there's a lot there, isn't there? But there's always a trick. You know, here at the bottom it says assume that profits accrue evenly during the year. Now, if that's the case, somewhere within the question there is likely to be a mid-year acquisition, which is very important, isn't it, in profit or loss, because you need to prorate the results. So what it says there is it says on the 1st of July 2015, ta-da, a miracle. So halfway through the year, Vader acquired 80% of the shares of Moore, a subsidiary therefore. So Vader's the parent, Moore's a sub. For a cash consideration of 90, the net assets was 85, the fair value of the NCI was 25, and the fair value of the net asset to acquisition was not materially different to the book value. So there's no fair value adjustment. If there's no fair value adjustment, then there's no extra depreciation, which is a bonus. But you have to ask yourself the question, why are we given that information? Because that information is very similar, isn't it, to the information that we saw in the group SFP that we use to work out the net asset to acquisition, to go through there and then use that information to work out goodwill. But goodwill is the statement of financial position figure, isn't it? So what's it doing there? Let's read on and we might see as we go along. It says on the 1st of January 2015, start of the year, no mid-year acquisition. Vader acquired 20% of SIF and exerted significant influence. So we therefore have an associate. Okay. The profits for the year were 100 million. We will equity account for that 100 million. We're then told it's group policy to measure the non-controlling interest at fair value. So that's going to be important, particularly if there's an impairment of your goodwill, because we need to give the NCI their share of that impairment. And lo and behold, in the next paragraph, it says goodwill has been impairment tested and found to have fallen by 20% in Vader. So in order to work out that impairment, we will need to know what the goodwill is. Because then once we've got the goodwill, we can work out the impairment, and then we can put the impairment in the group statement of profit or loss. Okay. So there's method to the madness, isn't there? Okay. We're going to have to actually work out the goodwill, even though it appears a little bit alien from a profit or loss perspective. We're going to calculate it to help us work out the impairment in the goodwill that goes into profit or loss. We then got bits and pieces. It says Vader sold goods to Moore. Is it there for 20 million? So we need to go through there and put in those intracompany sales. And we've made a loss on the transaction. Okay. I will update the note to make sure that that figure appears of what that loss actually is. And none of the goods have been sold outside of the group by the year end. Okay. So I think it should be there. Correct me if I'm wrong. Is it of 5 million? Okay. So we made a loss. Is it of 5 million? Okay. None of the goods have been sold outside of the group by the year end. Okay. Moore revalued its land and buildings at the year end. So Moore is the sub. And there's a revaluation surplus. Is it of 50 through OCI? No dividends were declared by any company during the year, so we don't need to adjust the investment income. Okay. So there's a lot going on. Okay. And particularly this new bit in terms of the loss on the transactions. We've only ever dealt with provisions for unrealized profits and eliminated the profit on the transaction. Okay. What do we do with the loss? We'll come back and look at that a little bit later. What we've got is we need to go through there, don't we? and have a look at the group statement of profit or loss. So what we've got there is we've got your group statement of profit or loss and other comprehensive income. And what we can see there is we need the revenue for P, S, adjustments, and then group. And remember, the sub, we need 6/12, don't we? Okay. We've also got as well to think about your cost of sales. Okay, so let's get the easy marks first, shall we? 1645 and 1280, but if we put in the 1645, remember 1280 we need to prorate by 6/12, don't we? So that's 640. Cost of sales 1205 and 990. 990, half of that in the sub is 495. If you want to get the easy marks within the exam, I do strongly suggest that you look at your intra-company sales. So they are there as 20 million. So we need to reduce the revenue by 20 and cost of sales by 20. Okay, there's no other adjustments to revenue. Revenue is one of the easiest figures to get. So we end up with group, is it revenue of 2265. Okay. Excellent. There was no material difference between the fair value, the net assets, and the book value, so there was no depreciation. You think there will be a PUP adjustment, like a provision for an unrealized loss. But if you've made a loss on the transaction, the assumption there is that that loss is at arm's length. Okay. And therefore, it's prudent, isn't it, to recognize that loss. Okay. If you can anticipate a loss, then you should recognize that loss in full immediately. So whatever figure we have for the loss on transaction, there is no adjustment, assuming that it's at arm's length. Okay, we don't make any adjustment there for that loss on the sale. Okay, because we assume that it's at arm's length, and therefore that loss is a genuine realized loss, so we should leave it in. Okay, don't remove it. We only remove any profits, provision for unrealized profits, not provision for unrealized losses. So just bear that one in mind. Okay, tiny little one I think the examiner threw in a good few sittings ago. Okay, if it's a loss intra-group, don't adjust for it, particularly if it's at arm's length. Okay. Then what we've got, various bits and pieces. We could work out what the cost of sales are, couldn't we? So cost of sales 1205 plus 495 less 20. Does that give me 1680? Gives me gross profit of 585. Okay. Distribution, admin. So distribution, I think was it 100. And let me just double check on the 70 of the sub. So is that 35? So that gives me 135. We've then got, is it our admin? So if I can find my admin, you've got 90 and 50. So I put in 90 and half of 50, which is 25. And then you've got your impairment, haven't we? Okay. So to look at the impairment, we need to work out the goodwill. So we went through there, we paid 90. The NCI was 25, so we add that on. And then we deduct, is it be 85? So 90 plus 25 less 85. Does that give me 30? and 20% of that is that as 6. Okay. Again, the non-controlling interest is measured at fair value, isn't it? So because it's measured at fair value, the impairment goes into the subsidiaries column. So of that impairment, the non-controlling interest will get their share. Because if we measured the goodwill at fair value, if we measure the NCI at fair value, then the goodwill is the full goodwill. So it's the parent share and the NCI share. Okay. We can go through then, can't we, and total those up. 90 plus 25 plus 6. Does that give me 121? Okay. You've then got PBIT. I'm not too worried about that. I won't put that in as a line item. I don't have time within the exam. So I'll go into my finance costs, 55, and then half of that 30, isn't it? So 55, half of 30 is 15. Does that give me 70, 55, 65, 70? Okay. There is no intracompany interest or anything of the likes there. Then just be careful, because what a lot of students will do is then go, right, PBT. No, remember, we have an associate, don't we? So on my associate, we own, is it 25%? Profits for the year were 100 and we bought it at the start of the year. There's no mid-year acquisition. So it's just 25% of 100. Okay. So we can throw in the 25 there. PBT 585 less 135 less 121 less 70 plus 25 gives me 284. Okay. Once you've got your 284, we're then into the realms of tax. 35 and half of 28. So 35 half of 28 is 14. So that gives me 49. Does that give me 235 as my group profit for the year? Okay. We then need to go through and look at OCI. So you've got there, is it your evaluation gain? Is it of 100? And is it there of 50? And it does say there, we revalued the land and buildings at the year end. And recorded a revaluation surplus of 50. Now this is where you just need to be careful, because when you've got your revaluation, so it was 100, you have to put in the 50 in full. Why? Because the revaluation took place at the year end. Okay, so at that instant, the asset had gone up in value by 50 million. It's not something that's accrued over the year, is it? It said profits accrue evenly. Other comprehensive income doesn't accrue evenly, does it? It just happens at a point in time. So that revaluation has pushed up the value of the assets by 50. So therefore, we control all of that valuation. The revaluation has happened because we have valued the asset and revalued it upwards by the tune of $50 million. Okay, so therefore, we do not prorate that one. Okay, be very careful. So you've then got, is it 385? That's your group total comprehensive income. I then need to total up S's column, don't I? That's going to be a bit of a challenge. I need to go right the way back up to the top. So we've got 640 less 495 less 35 less 25 less 6 less 15. Okay. Less 14. So S's profits for the year are equal to 50. The revaluation on top gives me 100, doesn't it? So what I need to go through and do now is I need to split that group total comprehensive income for the year. So that is going to be attributable to the parent and the non-controlling interest. Well, the non-controlling interest own 20%, don't they? Because we own 80. So they own 20% of that 100. So does that give me 20? The amount attributable to the parent is the balancing figure of 385 less the 20. So that gives me 365, which is your balancing figure. Okay. Wasn't too bad, really. The only issues that you had, wasn't it, was prorating the results of the sub, the intercompany sales, ignoring the loss, because that loss we assume has been realised. It's not an unrealised loss. And was it there the impairment of the sub? Okay. Threw in a little bit of OCI just to keep you happy with it as well. Okay. Work through the example again. We don't really touch upon profit or loss that much. We will build it up as we go along where we see it. But for the time being, make sure you're happy with the fundamentals of that example, because if you can't do that example, you're really going to struggle as we then introduce more complex aspects of group accounts as we progress through the syllabus. So take a bit of time out now to ensure that you're fully happy with that example, and then I'll see you all in the next session.